Hello everyone, I'm Brandon Garrett from Ben Oak Capital with your July 2021 Economic Update video. In this month's video, we will focus on a measure that has gotten a lot of press coverage recently, inflation. Please stay tuned to the end of this video for a required disclosure statement. Inflation has been on the rise. Investors are not as interested in what's happening now as they are in what's happening next. Meanwhile, the Federal Reserve shared its views at the conclusion of its policy meeting on Wednesday, June 16th. And while the Fed's position that inflation is likely to be transitory has become stronger, not weaker, Fed members have seemingly different opinions on the future path of monetary support. Inflation has been rising and the Fed is watching. How will markets react to any potential inflation over the next year? We do know this: markets will be looking forward, not backward. By the time something becomes a thing, a meme, or makes a magazine cover, market participants are often past it. Markets are no longer watching to see if inflation will spike. It already has. In fact, since a big upside surprise in the April inflation data, released May 12th, many inflation-sensitive assets have been underperforming. Copper, down. Lumber, down. The 10-year Treasury yield, down. Market-implied inflation rates, down. Gold, down. We know there are areas where we're seeing extreme price moves, which is impacting broader measures of inflation. But what about prices that tend not to move? There is such a measure developed by the Federal Reserve Bank of Atlanta called sticky core inflation. As seen here, unlike CPI and even core CPI, sticky core prices are not setting multi-decade or multi-year highs. Sticky core CPI is up 2.6% year over year. The last time it was that high was 2020. There are still some warning signs though. While you have to be careful annualizing monthly data because it multiplies small, potentially meaningless moves, annualized sticky CPI in each of the last 2 months was over 4%, and that hasn't happened since 1992. We do think inflation will be elevated over the rest of 2021 and possibly into 2022 before it really starts settling down, but that's still consistent with inflation being transitory. And it may remain somewhat higher after that compared to the last cycle, as deglobalization and a potentially weaker dollar offset some of the forces that we think will continue to weigh on inflation. If inflation does start to look more persistent, it will certainly be felt on Main Street. For Wall Street, the immediate fear wouldn't be the inflation itself, but rather its ability to force the Fed's hand and accelerate policy tightening. But based on how markets have been responding recently, the Fed's position that inflation is likely to be transitory has become stronger, not weaker. In conclusion, we know that inflation has certainly been the word of the year. Consumers and investors have seen and felt the impact of inflation. But the structural headwinds that have kept inflationary pressures at bay for decades are still in place. We do think inflation will be elevated over the rest of 2021 and possibly into 2022 before it really starts settling down. But again, that's still consistent with inflation being transitory. How the Fed reacts to the data will be interesting though. We continue to monitor the risk associated with the Fed acting out of concert with what markets are expecting. Thanks for watching this month's video. If you have any questions about what we discussed, please give us a call at 817-550-6750.